Good morning, folks. Welcome to another podcast with Sunset Builders and Maintenance. Today we're joined at the table with someone that's very fascinating to me. Laura Sanchez is a mortgage underwriter. And did I get that right?
Loan officer.
Loan officer, sorry. Before we get into this discussion today, just real quickly, if you have any home renovation work that you'd like to have done, we hope you give us a call here at Sunset Builders at 239-236-9646. You can find us on the web at www.sunsetbuilders.net. You can also email us, info@sunsetbuilders.net. I'm going to let Laura introduce herself. She is someone that I met at a veterans networking event, Southwest Florida Inc., I believe it is. Yep. Take it away, Laura.
Thank you, Mark. Thank you for having me. I appreciate it. I am Laura Sanchez. I'm with Guaranteed Rate Affinity, a national lender. My NMLS number is 413938. I have to say that. You can get in touch with me. My cell phone's probably the best. 216-272-1015 or email laura.sanchez@grarate.com, and also on the web, I think it's www.grarate.com/Laura Sanchez with no dot in between the Laura and Sanchez. So yes, I have been in the lending world for 25 years, so I've seen a lot and things have changed a lot, and like that book about who moved my cheese, our cheese gets moved all the time.
Laura, you and I are like polar opposites because I am 50, never mind how old I am. I've never owned a house before, ever. And here you have so many years of experience in coming up with mortgages for people that are buying houses. So I'm currently looking to diversify myself and wanting to buy real estate. And it occurred to me pretty quickly that in addition to a realtor, it would help me to know someone like yourself that could kind of coach me, because there's more than one way to finance a home, isn't there?
Hundreds of ways to finance a home. There really are, and that's the issue. It is overwhelming, and as a first-time home buyer, there's so many options. The key is, we've talked about this, is with the realtor, the price that you buy the house for when you're going in, that is the most important. So the best price you can get, not the rate.
Now wait a minute, back in the day it used to be location. So now it's...
But locations change.
Price.
You've got to get it for the right price.
Gotcha.
You just do. That's the most important. And there are so many different categories of loans. First-time home buyers, people usually think of FHA loans, which is a great product for first-time home buyers, not the only one. Fannie and Freddie have 3% down programs, which is not a lot for first-time home buyers with decent credit. Veterans is by far and away one of the best programs ever out there, and so it should be. Thank you very much for your service. I mean that. I do have a lot of veterans in my family. Some not with us anymore, and some still with us. And it's important for that giving back. And so I got involved with the VA not just because of my family, but there's so many myths and misunderstandings about the program, and veterans...
You should be on this side of that coin.
And veterans don't use that program enough because they are, for the most part, such good people, and they think it's for someone else. Let someone else... There's not like a pool of money that says, only you get it, or it's for everybody. And if it's the great program with low rates, low down payment, no PMI, why not use it?
Right.
The only time that the VA loan can't beat another loan is if you have excellent credit, 50% down, and you don't have your funding fee waived. So, because the funding fee is part of what you pay the VA to guarantee your loan. So if you don't have that, then conforming is going to beat that one. But other than that, it's hard to beat a veteran loan, and most people don't know that you can do a renovation loan with the VA loan as well.
Okay.
And what renovation loans are is where you either it's purchase or rehab if you already own it. A renovation loan is you take the renovation amount, you get a bid from a contractor that's licensed and bonded the whole 9 yards. You can't just pick your neighbor Joe off the street who doesn't do it for a living.
Right.
And they have to give you a bill of materials with labor and materials separated out, so we see who's paying, who's doing what parts of that. So you get your bid, and then I'll make it an easy example. If you're buying a home for $150,000, and there's 50,000 in work, your all in is 200,000. So we're going to go do an appraisal with your bid that says this home has to appraise for at least 200,000. Even though it's not worth that today, because there's a hole in the roof or a hurricane came through and whatever, doesn't matter. We're not going to appraise it with today's value. We're going to appraise it on an after repaired value. And that's how all renovation loans work, whether it's VA or anything.
So this particular instrument would work well, and I can't tell you how many times I've heard this. Hurricane Ian wiped out my home. My insurance came in and lowballed me, and I got this, but I need this.
Right.
So that type of thing could help out.
Exactly.
Okay.
Exactly.
Now you mentioned something a minute ago, and ironically I was just listening to one of my investor classes yesterday, and they were talking about the recovery of Freddie and Fannie. Now my question to you is, as a mortgage or loan lender, are those bad words right now, or or do you feel better about those two institutions?
That's a loaded question too, because
we always ask the tough questions.
I know, because they're private, but not private companies.
Right.
You know, because when they screw up, the government just bails them out. So when you screw up, does the government bail you out?
Oh yeah, the IRS is waiting at my door. No, they don't.
So you see my point. You know, so they're right now they're necessary evils, but you don't have to use a Fannie or Freddie loan. If you lean towards Fannie and Freddie, typically they're going to have the best interest rates. You know, keeping VA aside, VA is, you know, it's up here, but there's all sorts of loans out there. For example, if you're self-employed, and which you can do, you can write everything off on your taxes and show no income to the government and pay no taxes. That is legal. If you have all the right write-offs, it's perfectly legal. However, your adjusted gross income is zero.
Right.
So when you go to buy a house, your adjusted gross income is zero, so you can't buy the house.
You can buy a house for zero.
Right, right. But so there's other non-conforming loans where you can use bank statements to prove your income. You can do other things, but everything that shows less information is riskier. Risk equals higher rate.
I was going to say, you had sent me an email a couple days ago that made that very clear to me for the first time. The more non-conventional, I guess would be the way I would say it, a loan or a finance instrument is, the more you're going to pay in interest rates.
Right, it's risk. I'll compare the bank statement loan to the 16-year-old male child getting his driver's license and insurance for the first time.
Right, no backup.
Very expensive insurance, and that's because the risk is high.
So personal question, and if you can, I would love to hear your opinion. Fixed or adjustable interest rate right now?
So what happens is interest rates are determined based on what Wall Street does. They buy, the Fannie and Freddies, they buy loans on the secondary market. So it's like anything else. Whatever is attractive for them to buy, they buy. We went through a long period of time where Wall Street had zero appetite for adjustable rate mortgages.
Right.
So they weren't buying them. If they're not buying them, it's supply and demand. There's no demand, so the adjustable rates were higher than a fixed rate. Why would you do that?
Right.
There's been some, like the FHA adjustable. I've refinanced several people recently. VA loan adjustables were way lower than the conforming adjustables were. And
my parents just bought their house back in 1999, the one that they're living in right now, and the interest rate they got on that was in the sub threes. I think it was incredibly low.
Yeah.
And I can remember as a child, interest rates on houses being in the teens.
Yeah.
Once again, not telling you how old I am.
Yeah.
But they were, and people were thinking, at that time, if we could get a loan 7 to 8, 9, 10%, which is where we are right now.
Yeah.
Oh my God, how great that would
be. Right. So everything's relative and everything changes constantly. So sometimes adjustable rates are better than fixed and vice versa. So what you have to watch for in an adjustable rate is the terms that it can adjust. The safest adjustables have always been the government ones. Government is USDA, VA, and FHA. Those are all government-backed loans. Okay. They don't want people to be in trouble. They don't, because they either have to insure the home if it's in default, or like the guarantee for VA, they guarantee that loan, and they physically buy the house back. So they're different from FHA because the VA guarantees it, means they're going to own it. FHA insures it, means the insurance is going to pay for the lender for that default. So a little bit different, but they want safe arms. So right now that VA arm is a 5-1 arm, and what that means is it's fixed for 5 years. Can't change. So if you're going to live there for 5 years, and the rate is 5.75, let's say for the VA arm, and it's 6.5 for the fixed rate loan, why wouldn't you do it if you're only going to live there for 5 years? The other thing that 5-1 means is it can only adjust 1% per year. So worst case scenario, it's not like your loan's going to 10-12% in the 6th year. You have plenty of time to refinance. Most people jump the gun and do it too early. If you're going to move in 6 years, we'll just take that 1% increase in the rate for 1 year and then sell it. Or if you wind up staying, then you can refinance it. But people jump the gun way too early on refinances, in my opinion.
Okay.
Just
let it come down.
Yeah, just chill, and there's no urgency to refinance it. There were, when that home mortgage meltdown thing happened, there were crazy adjusted ones. There were ones that adjusted every month, every 6 months.
Right.
And the caps were high. So you could go automatically from, like a 6 to a 10, after 6 months. That's not good. So you have to watch. When you sign all your papers, there's a rider. On that rider, it says how long it's fixed for, how much you can adjust on the first adjustment, and then also a lifetime cap on adjustment. So like a 5-1-5 would be fixed for 5 years, only change 1% per year, and only a 5-point cap. Like if you started at 5, the highest you could ever go is 10.
Right.
But at a rate of 1% per year, so you have plenty of time to get there. So just watch what Wall Street is buying, and always ask would an arm would be better. Sometimes the answer is yes, sometimes it's no.
You'll have to forgive me because I come up with ideas that I want to ask you while you're talking. So
That's okay.
Catch me scribbling notes here.
Yeah, that's fine.
In my world, if a customer wants to retain my services, we typically provide them a contract and that says, this is what you're going to pay me to do this job. This might be personal, and if it is, you can tell me to shut up. I'm not answering your question. How do you get paid for doing your work?
So all loan officers get paid if the loan closes. So
it's a portion of the proceeds from the closing.
Right. Because our company gets paid when the loan is purchased on the secondary market. Our company splits that commission, them and us. So
you're in essence like a realtor. They get this much percentage of the house, you get this much percentage of the loan.
Right, and it varies from loan product. It's not all the same across the board because we have a lot of different loan programs.
Okay,
so I mean it's fairly similar, but
my next question is, you've been doing this for 25 years. People ask me this question: why should I hire you over this other company? I'll ask you the same question: what differentiates a mortgage loan officer from you, from A, B, and C? What am I looking for?
Experience, like you. I mean, just how long you've been doing it. There's so many different things that come up in real estate that, I'm doing it 25 years, I'll say, oh my God, I've never seen that before.
Right.
And it just happens, and you have to be able to adjust and know what's out there to pivot. A rate's a rate. When we talk about people buying houses, marry the house, date the rate. Because people are refinancing, they're doing whatever, they're moving. I mean, the average time that people stay in a loan is 7 years. It's not 30.
Right.
People aren't staying in their loans forever. So, ask somebody what their interest rate is. And invariably, they're wrong. It's like, what's your rate? Oh, I have a 6.125. And then you get their statement. It's like, or 6.375. But yet they fought tooth and nail for that eighth point, when they got it. But they don't even know what they have. It's just like if you ask your financial advisor, how much does he charge you? Huh?
Yeah.
I don't know. You don't know. Every year they charge you. It could be $20,000. You don't know. But people don't pay attention to that. But they pay attention to that eighth of a point. So marry the house, date the rate. Buy a home that you really want in the location that you want, that fits your needs, whether it's investment property. If cash flow is your game, then make sure it cash flows. If it doesn't, that means you're going to be supplementing that payment out of your own pocket if it doesn't cash flow, and are you prepared for that?
Right. So here's my next question. I'm a new home buyer. I'm an Army veteran, college graduate. I'm a hillbilly from Eastern Kentucky, very proud of my UK Wildcats, even though we got bumped out a few days ago. How much information, what information should I bring to you, my financial guru, in order to, so that you can figure out what's the best deal? What are you looking for from me?
Well, and I'm glad you asked that, because on a loan application, a lot of people don't like to do them, they like to do digital or whatever, but I always like to know those little intricacies like a veteran, because that's going to open up a whole different avenue of opportunities for you that I would look at. And it's VA loans are either for veteran and spouse. Right. Veteran loans are not for veteran and daughter, veteran and girlfriend. It has to be veteran and spouse, or only veteran. So that's something that a lot of people don't understand.
Okay.
But if you are a veteran and you're a first-time home buyer, I would put those pieces together, and I would say, number one, you should be using the Florida Housing down payment assistance programs, whether you need it or not, because it's almost free money. So even though
I love free is my favorite word. Tell me about that.
That's my favorite F word. I always say that's my favorite F word. It's free, and truly, I always look for the free way to do something. I don't know about everybody else, but so with Florida has some of the best down payment assistance programs I've ever seen before. Me moving from Ohio, not far from Kentucky. I was on the fence with a lot of their programs. The Ohio ones are better now than they used to be, because I still am licensed in Ohio. But the Florida programs they were great to start with, and then after COVID, when they added the Hometown Heroes arm of that made them even better. So the reason why I say use them is because worst case scenario, you'll get $10,000. Maybe that's not a big number, but when you want them to pay your closing costs, I would. Yeah. Their down payment assistance comes in two flavors. One of them is, forgivable. The other one is not forgivable. But on the non-forgivable one, there's no interest ever, and there's no payments required until you sell. So it's kind of like free money.
Sure.
You have to pay them back. If you get $10,000 from Florida when you buy, you just have to give them that money back. You've used their money, and you didn't have to pay for it. They have other programs that are totally forgivable in 20% increments over, 5 years, but the interest rates are a little bit higher. So it just depends. I always do. I'm a numbers person. I actually have a civil engineering degree, so I'm a math major.
No kidding. So. I can put you to work tomorrow for that.
And my dad was an architect, so there you go. So I grew up, with drawings and buildings and him and numbers. So there you go.
Very nice.
But so I overwhelm people with numbers. I usually give them all 3 different Florida housing programs if they're first-time home buyers, or don't use a program at all and just don't use them if you don't want to. But for veterans, for example, if you're using the VA loan, you don't need any money down, so it's no money down.
Right.
So wouldn't you take their extra money if you could and not have to pay for it? And the rates are great. The other thing that Florida does, I don't know about all states in the country, but Florida also, 99.9%, not all, but 99.9% of down payment assistance program require you to be a first-time home buyer. What Florida does is they exempt veterans always from the first-time home buyer rule. Yeah. So you could be your 10th home and still use the Florida down payment assistance programs. Nice. For money, and that's unheard of.
So it sounds like you're answering my next question, but I'll throw it out there anyway. You've been doing this for 25 years. What's the most exciting financial piece of information that's come down recently that you just, oh my God, I need to tell people about that? Or is there anything? Has it changed much recently, I guess?
And there's always little pieces, parts. I mean, some good, some not so good. You wind up doing, I moved from Ohio. In Ohio, how many condo loans do you think I ever did in Ohio?
Not many. Unless you live up near Cleveland or Chicago. Or I'm not sure.
Right. Well, think about it. So I think I did one before I moved down here, because there's not that many people, they call, Cleveland's not that bad, but they had that nickname Mistake on the Lake because as opposed to Chicago, they decided to put all their steel mill production on the lake. Right. So not conducive to condo living.
No. Oh, look, it's a freighter.
Pretty much. That's what people do. They look at that, and then the barges go up and down. Then move down to Florida. 50% of my pipeline has always been condos.
Yeah. And now, is that still the case right now?
Yeah.
because.
But I mean, I'm going to answer your question because the most recent guidelines that came out were even more restrictive for condos, and people are not going to be happy about that.
Now, those restrictions, is that because of the building itself?
Because of what happened on the East Coast.
Miami, the condo that collapsed in
Yes.
Miami. Yeah, that was the perfect storm for, and not in a good way.
Right.
We had that building collapse. It was 21, 22, something like that.
Yeah.
And there were several engineering laws that came out of that collapse.
Right.
And then we had this nice little storm called Hurricane Ian that hit us in September of 22.
Yeah.
And engineering prices have exploded. I was just this morning. I was talking to one of my associates, and she was like, "Oh my God, it was $3,000 to get this little drawing from an engineer." I said, "Yeah, 4 years ago, I could have got that drawing for $600."
Yep.
And it's just the supply and demand on
Right.
engineers' time.
Right, and it takes a lot to get your PE. I know, going to civil engineering school to get that PE license. That stamp is golden because
all of
you pay for the
those
stamp.
condo threshold inspections is what they're called. That law went into effect January 1st, 2023, and so every condo building around here has to go through a threshold inspection, and if anything is identified as crucial or critical or something along those lines, it has to be fixed immediately. And so a lot of these condo associations have burnt through all of their reserves.
Correct.
They're doing special assessment after special assessment after special assessment, and many of these homeowners that were buying these properties are senior citizens on fixed incomes, and
Yep,
they
they
couldn't
can't afford
take
it.
it.
Right.
You know,
Yeah.
my mom and dad sing my praises every day because I got them out of a local condo just not far from here in 2019.
Oh, yeah.
And
Good timing.
yep.
Good timing.
I said,
And, I mean,
I'll
that-
live behind you. I'll help take care of you. And
Literally last week, Fannie and Freddie came out with their new and improved guidelines.
Yep.
And of course, I think a lot of it is trial balloon stuff too, because now, all of the other people that are in the industry are all coming at them and fighting them.
Right.
National Home Builders Association, everybody's saying you can't do this because they want to raise the reserve requirement that's now 10% to 15%. You used to be able to.
I'll tell you from a builder's perspective, because I watched several condo organizations. There's one on Sanibel that had boots on the ground 4 days after the storm. Mm-hmm. They had their cash reserves set up. They were in great financial shape. And I have given their property manager kudos time and time again. She has since moved on. They blew everybody away as far as what they were able to get done for their tenants and get that building. Mm-hmm. They were back in business within a year.
Wow.
And I know places.
For Sanibel, that's amazing because
I know places still on Sanibel and even more
Beach.
places on Fort Myers Beach that aren't
Still
even
aren't.
close to
Right.
opening.
Right.
And a lot of it is the tug of war inside those management groups.
And you say timing is everything. You talk about wanting to have investment properties and buy investment properties. Well, Typhoid Mary here bought a condo on Fort Myers Beach in April, the year we got Ian's.
Oh God!
So I've lived all that. I'm living the condo guidelines.
I can't tell you the horror stories that we've heard.
Yeah.
And not just from the storm. The other one that just drives me absolutely bananas is these overnight contractors that show up in the wakes of these storms that know nothing about the Florida building codes or these local municipalities.
The 50-50 rule.
The 50-50 rule, my favorite rule.
Right. Oh, mine too.
And that's not, if you go to a bar, that's not whether or not you're going to get a date. Okay, it doesn't work that way.
No.
This is how much you can spend on your home. And
the government telling you
in the wake of because basically they want all of these ranch homes within the floodplains to be gone. And
Yep.
That's a harsh way to put it, but that's what they want. They have determined that providing the FEMA insurance money and that to all these folks that are in these areas, Cape Coral, you have a huge coastline that's in that zone, Fort Myers. My family's house
river.
right over off Cypress Lakes, we're in that flood zone. Most of Sanibel, I think, is if not all of Sanibel is in that floodplain, and with Fort Myers Beach as well, and then on down the coastline.
Yeah.
They want the ranch homes gone.
Right, and that also circles back to your condo part. Not only the Fannie and Freddie rules, but the they've increased insurance requirements.
Right.
So it's a lot of factors.
And it doesn't pay for anything if you're in Zone X.
Right.
You have to have flood insurance, but We're not going to pay for anything. It's a racket.
It is a racket.
I want to get involved in that somehow. If somebody
Yeah.
can get me in the insurance business, come and talk to me. I think it would be good.
Yeah, yeah. So, I mean, for me, there haven't been a lot of new or great crazy increases in loan products. There are always going to be the companies out there that want to take more risks, like with no income verification and all that. But you can see when there's too many of those, we had the crash in so if you go, it's a
Could
pendulum.
that still happen?
Crash?
The no docs.
We do have. They exist.
Right.
But the
those
rates are so high.
Those are private lender
Correct.
instruments, okay?
Correct.
As opposed to...
If you could pay 10-12%, then, go do it, because they exist.
Right.
But once you see the cost of it,
Right.
like, maybe I'll just file my taxes better next year.
So the difference is in 07 and 08 when the crash happens, every bank in the land were writing, I called them liar loans, they're called
Yes.
no-doc loans, stuff like
Yes.
that. Since the crash has been mitigated and we've kind of come back out on the backside of it now, the federal government said, okay, all of you standard organized banks can't write those loans. They can only be written by private lenders.
Yeah.
And
They want to risk their own money.
That makes you feel safe a little bit, but the private lenders are also invested in by the major banks. So it goes.
Yeah.
It hasn't stopped. So
Right. Right. Yeah. There's risky stuff
how
out
do you
there.
answer the person's question? And we might wind this one up here if we're getting close. I'm thinking about buying a property. I'm just not sure right now is the time. We've got this president in office or that president. How do you answer someone who comes to you with those kind? I mean, this might be more of a realtor's question, but how do you answer that question to someone who's in that mindset?
It's always the right time to buy a house if you get it for the right price.
Gotcha.
Because even though, when I moved here to Florida, when I bought my house, I bought just before all the prices went up. So, I mean, what I bought my house for then, I thought was like ridiculously expensive. And I'm not saying it increased, 100%, but at least 50% in a short amount of time.
We just looked at a property on the MLS before we came on the podcast, and it was 2021, I think it was.
Yeah.
That property had sold for $359,000, and now it's being listed. It hasn't sold, but it's being listed for $600 currently.
Right. So I mean, those are huge jumps.
Yes.
And we never, on average, real estate, is going to appreciate long term 3% over
Right.
time. Not hugely. It's a good investment because here in the United States you have some write-offs. You can write off your real estate taxes and things like that. So it does give you some tax advantages to own a home versus renting. It will appreciate.
Are those discounts still as good or write-offs still as good today as they were 10, 15, 20 years ago, or have they kind of...
They're not quite as good, but they're still worth it because you have no write-offs if you rent. So it's better to buy than rent, in my opinion. Otherwise, I wouldn't have other properties.
If my choice was $2,000 a month, 2-bedroom, 2-bath rental, or $2,000, even let's say $2,500 a month buy, same house, you would say even at $500 difference, you're going to say buy.
Yeah.
Okay.
And always look for the fixer-upper. We talked about it, and maybe we do this at another time, but there's so many fixer-upper loans in addition to the VA loan that you can get that money to fix up the house. And if you do it right, it'll be worth even more, like the appreciation plus you rehabbing it makes it worth more as well. So
Equity.
There's a lot of ways to make money with using rehab loans. So
Awesome.
I love that product.
All right, let's take a quick 5 seconds and check with my camera person extraordinaire. How are we doing back there? Okay, folks, we're here again with Laura Sanchez. She is a loan
Originator.
That's a tough word.
As opposed to Lone Ranger.
Alex, I'll take letters only I know. And you can't see him, but Gunner's down here at our feet. He's my French bulldog. I'll see if I can give him a picture. Say hi, buddy. Say hi. He doesn't. He's camera shy. If you're just tuning in, we've had one podcast in front of this with Laura where we talked a lot about different topics of financing, real estate properties and homes. And now we're going to do a little bit more of the connect the dots, so to speak, as to why I brought her here in the first place. How a loan officer and a construction company have common shared interest, and that is, as homeowners or home buyers, you might find a property that is less than stellar may need a little bit or a lot of work.
Or like you mentioned, you know, the hurricane came through and they don't have it, they own it now,
Right.
and they don't have enough money to fix it, and they need that money to fix it, and
So
you
let
can do
me
it
throw
without
one cautionary thing out there right now, folks. If you're up in the north and you're watching my video and you think I'm going to move to Florida and I'm going to buy a hurricane gutted house, okay, you need to call someone like Laura or myself, and you need to ask one question. Laura, tell me about the 50-50 rule. Now, I've already spent a whole podcast talking about that. You're more than welcome to call me and ask me, because it is very, very possible that you could buy a house in Florida right now that needs to be renovated that does not have the how do you say it, doesn't have the financial capability of being renovated because of that FEMA 50-50 rule. Did I say that?
Yeah,
pretty close?
yeah. It's just, it's so complicated, it's criminal, if you ask me.
So in a nutshell, basically what it boils down to is FEMA says you can only spend 50% of the building value, not the lot and the pool and the house, just the house, 50% of that house value on the entire renovation to put your house back the way that it was pre-Hurricane Ian. So what they're doing is whatever year you're buying, they will take the tax values, or you can hire a private assessor to come out and evaluate the home and tell you if it were back to new, this is what it would be. And they'll tell you, here's your building value. And if that building value was $200,000, $300,000, $400,000, you have half of that. Okay. Now what we found the hard way is the larger the square footage of the home, the more you get up above 1,800 to 2,000 square feet, the harder it is to make those numbers work. It's a, you know, you start thinking about a 12 to 1,500 square foot property, and I don't care if it's a condo, is a whole different ball of wax. There's a whole different segment to this 50-50 rule that applies to condos, and I'll touch on it real quick. But just on a house, you know, you think you got 1,500 square feet and you've got this basket of money to renovate that, that's one thing, and you expand that up to 2,000 or more square feet, and it just becomes harder to do. And FEMA's very strict right now, especially down in Lee County. There was some, I don't want to say it was purposely done wrong. I think there was just a lot of rules that unfolded over time that the different communities and counties didn't know about up front, perhaps. So a lot of these municipalities are backtracking now, trying to get all their documentation lined up. Cape Coral, you guys are getting letters from their county or from your city governments telling you, yes, we've seen that you've done work on your house and we know you didn't pull a permit for that. Now you need to come in and take care of that. We can help you with that, by the way. We've done several of them. But why condos are different than a house is, let's say you've got a 20-unit condo complex. That building has an assessed value, okay? And so every one of those units take a portion of that master value and gets assigned accordingly. Now, when the storm first hit, nobody understood that. And the first folks that had the money to renovate their condos, they kind of, you know, got the lion's share of what they could do whatever they wanted because people didn't understand that basket. And then it was about a year into it where FEMA came back and said, that's not the way that works. Okay, and then Sanibel and Fort Myers Beach and even Fort Myers and Lee County, all of them started and they really started tightening up the loans. The good news is some of the upper floors in some of these condos, they didn't need any work at all. They were fine. The lower ones, they had gotten completely wiped out and they needed a lot. So the boards all got together and they kind of assessed and divvied up the pool the best way they saw fit.
It's crazy.
It was.
It's crazy.
This was like the Wild West back here in 2022. Yeah. And those of us who went through it, just like Charlie, I was here for Charlie. Just like all the contractors and the people that worked through Charlie became more knowledgeable. Having lived through Ian, having done all of this work post Hurricane Ian, you know, now I'm confident in what I tell customers about doing hurricane work. But the next one that comes through, and there will be a next one.
Yeah.
The rules may change again, and they likely will.
Yeah.
So That being said, Laura is going to talk to you, and that was a long diatribe introduction. Sorry about that.
That's okay.
Laura's going to talk to us now about some, they call them instruments, if you will, of how you can obtain money to renovate your existing home or your newly purchased home. And that said, all right,
Yep.
take it away.
Thanks. Well, there's so many different ways to get money. I mean, you could go and if you have great credit, you can go get a credit card, get a big old line of credit card, and put it all on there. And over time, you'll probably, on a $30,000 credit card at 23% interest, wind up paying, $90,000 for that deal.
Right.
Probably not the best way to do it, but it is possible to get money through credit cards to do stuff.
Okay.
If it's and then when it comes to mortgages or home loans, because a home equity line of credit is a home loan, it's not a mortgage. So there's two camps of loans. One are loans that you get that are based on your appraised value today, and there's loans that you get on projected value. So two examples of value today is my house is in pretty good condition, and I just want, it's just dated, so I want it all updated. And I've lived there for a long time. I want to do what's called a cash out refi. So you could typically do a cash out refi up to 80% of today's value and pay off the old loan, get one new loan, and your new loan, the cash you will get will be that loan subtract, and then subtract what your current balance is, you cash out, and then you'll have this fixed amount to do whatever it is that you want to do. So that's a cash out refi based on existing
I have a question
value.
real fast. When somebody starts talking about getting a loan funded for a house and everything, in my mind I'm thinking it's going to take 7 seasons of the Brady Bunch.
30 days.
Really? 30 days. So if you come and start talking to me about wanting to renovate your house, if you start your loan paperwork right about the same time, we should be good to go.
Yeah.
I didn't know that. I thought it was taking.
Yeah, no. And then there's a home equity line of credit. Again, typically on average, it's not all, but let's say up to 80% loan to value. Let's say I've got this great 2% rate on my first mortgage. I don't want to redo the whole thing. I just want to get the difference between the two. The beauty of the home equity line of credit is it's a little bit more flexible. When you do the cash out refi, you get a lump sum at closing. That's it. You're done.
Okay.
Home equity line of credit, if they give you a $100,000 line, maybe you invoice them for 20 grand, they give you 20 grand, now you're paying on the 20 grand, you need another 20 grand, now you're paying on the 40, so you're only paying for the amount that you use. If you don't use all 100, you're not going to pay all 100. Pluses and minuses to home equity lines of credit is because you can get them fixed as a loan. Most of them are line of credit. Most people just, when the bill comes in the mail, it's interest only. And how many people do you think pay principal and interest, or how many people just pay the interest?
Right.
And that sucker just sits there. And that's what the banks want. They want you to pay interest forever,
Sure.
And not pay them back until you move. So you have to be diligent on doing that. And those are on today's value. But let's say I want, and I don't know how big, you could tell me how big your renovations go, but let's say I have, for whatever reason, people want to do it in.
I want to do a whole house renovation projected.
What if you want to add? What if you want to add a second story? I have a 1-story house and I want to add a second story.
Don't do it.
Okay. What about an addition on the back?
So I want to touch on both of those real quick.
Okay, because you could do that with a renovation loan, and that's what I was going to talk about, that because that's after repaired value.
I'm going to use Cape Coral as an example because most of those lots, if you've ever done an aerial view of Cape Coral, you'll see that all those lots look very similar. Most of the time when they built those houses over there, I'm not saying every time because it is possible, but most of the time when they built those houses over there, they did not leave you a whole lot of extra room to add on. You might be able to get a small pool in there, things like that, but even if you were looking at a 12 by 12 or a 10 by 10 master suite addition, something that's not that big, that's 100 to 120 square feet.
Right.
You may not have the land footprint to add that. So that's the first thing I would say. We should talk. And then building up, we just ran through this. If you want to hydraulically lift your home so that it's no longer at floodwater level, that's one thing. building on top of your house, it can be done. It is exponentially more expensive.
Okay. And Florida's a little bit different than where I came from, in Ohio. In Ohio, people put second stories on all the time because they're wood, they're framed.
We have
they're
this
not the
stupid
concrete.
little thing called the Florida Building Code, and it's everything is contingent upon something, and it all starts with the foundations down here.
Well, let's say you're out in Golden Gate and you have this 5-acre lot and you have this tiny house in Golden Gate and you want to expand on it. A renovation loan is built for doing more than what the home is worth today. So if you have big plans and big projects, and so you don't have to worry about your loan to value is going to be based on after repaired value, and on a conforming loan, so you could have your former, like if you own it now, let's say you owe $100,000, but you want to put $200 into it, so you have a $300,000 loan, and that's going to make it a $400,000 house. You can do that.
Gotcha.
Because it's not a $400,000 house today. But if you're, I'm sure Fort Myers and these areas have bigger lots and stuff like that too, or put in a pool, or whatever it is that you want to do that's more, or a cage, or you name it. As long as it's renovating the house.
Okay.
If you want to use a renovation loan to build a barn, no, that's not renovating.
Okay.
So, and a renovation could be the house burned down. And there's two different cases in that regard. So with renovation loans, you have the VA renovation, which is restrictive because you can only do about 50,000 in renovations on the VA loan.
Okay.
The VA renovation was more intended for veterans coming home that needed a lot of modifications because of their handicaps or whatever that came with it. So it wasn't meant to take a $100,000 house and do a $800,000 house. That wasn't the intent of that renovation loan for veterans. FHA, again, the most forgiving on how bad the house could be. So with an FHA loan, you could have a fire, the foundation's still there, and one wall, and you can rebuild that house.
Yep.
You can't get a loan on that house today because there is no house. So the value today is nothing because it's a foundation and a wall.
Right.
You can use an FHA loan to rebuild that house.
Nice.
Even though it's not in livable condition, or the roof, whatever, it doesn't matter. Conforming, again, they have like your 50-50 rule. They have like a 75% rule.
Okay.
Now, you can take a home that, let's say there's a builder that went belly up. He didn't finish the house.
Right.
No, it's never been occupied.
Yep.
You cannot do that with FHA because that's not renovating. That kind of goes along, it's kind of new construction.
Right.
But you can use the conventional renovation as long as it's 75% complete to finish the house. As long as the mechanicals are in and things like that, it can't be just a shell.
Can't be a shell.
Right. So it's substantially completed, 75%. You can finish that house, and that we're talking about good deals. There's good deals if you could find. There was a time period here where there was tons of builders going belly up.
Yep.
And that would have been a good time to buy one of those. I call them builder belly up houses because
back in 07, 08, and 09, if you lived down here, you could, especially, we used to see them all the time up in Northwest Cape. The builders had, thousands of houses started up through block and tibing, and they were gone.
Yeah.
Just you saw skeletons sitting in the yards.
Yep. And they're worth what someone's willing to pay for them.
At that time, you could buy those properties, and I kicked myself for not doing it.
Don't tell me.
You could buy those properties with the building started for anywhere from $15,000 to $30,000 all day.
No way. No way.
Vacant lots were going for $5,000 a pop.
Oh my God.
This was back right at when the market crashed.
And it's just, these are things that you don't think about, like when you go out to buy a house, what should I look for?
Right.
Look for the screaming deals.
Yeah.
And those are screaming deals, and they're out there, and it might not be exactly, you said location. It might not be the perfect place you wanted to live, but if you're getting a screaming deal on it,
take a break. Just had a customer walk in the door looking to add an addition to his house, and so Laura started drooling a little bit, and we paused to talk to him. Anyway,
that's exactly right. This is exactly what we do. So it's kind of ironic that that's what we talked about. But
very serendipitous that he walked in while we were talking about this.
So conforming loans, you can finish a home that's not been completed. You can add a pool. You can do all sorts of luxury things as long as you. It's not to say that you can't do something that's not attached to the house, but you also have to have something that is done to the house.
Okay.
So you have to be renovating. You can't just do something like an outbuilding or whatever. But I've converted barns with renovation loans into homes.
Well, I want to stop you right there because this is my next topic. I have a friend of mine who specializes in barnuminiums that are livable, and I've done some research through this person. They're extremely energy efficient. They are hurricane rated to over 200 miles an hour. I want to say 240, but I can't remember exactly. So I'm going to say over 200.
Yeah.
I've toured her home twice, showing it to other people. She's very gracious and will let me. And we might have talked about this once in private. I'm not sure.
Yeah.
But are there instruments out there that will finance a barnuminium in Lee County?
Yes. So it's two questions. So there's construction. There's barn door construction, and there's also renovation.
Okay, I'm talking about new build.
Right.
These are very popular in Lehigh, Alva, Buckingham, North Fort Myers. There are certain municipalities, Cape Coral, Sanibel, Fort Myers Beach, they won't let you put them up.
Yeah.
Which is a shame because they have a really, really nice cost per square foot price. It's extremely attractive.
Correct. Correct.
Compared to a CMU or a stick frame home.
And so it's a construction loan.
Right.
So which is different than, that's not Fannie, Freddie, whatever. It's construction loan for the most part, and it works differently. The trouble with the barn doors is because it's new, it's appraisal. And so you have to have enough, and when you do an appraisal, you have to have a minimum of 3 comparables. And so if there's nothing else like it around it, because you're talking about, just for an example, what a barnuminium in Lehigh had the same value on a 5-acre lot in Naples.
Right.
So yes, they're both barn doors,
right,
but the distance is too much. So that's the struggle, is you can get it done, but there is a lot of and there are lenders out there that will do barn doors.
We've talked about a lot of different instruments, and I'm not finished talking about this, but the one thing I keep taking away from listening to you is, if someone's in my shoes out there where you're starting this process of trying to finance something, it sounds to me like your buzzword should be patience.
Yeah, and exactly. Don't jump at the right, the shiny,
Yeah.
That's what I call new construction here, the D.R. Hortons, shiny,
Right.
They put all the nice furniture in there and everything's
Looks
silver.
great, smells good, new carpet.
Right, but when you walk in and you go, oh my God, the baseboard's uneven and the chrome holdings got glue all over the place, and it looks like it might be, pretty flimsy and fall off, after I leave. So it looks shiny and new and great, and it's in the right location. I love the spa that they have in there. But when you buy a house, if you're looking for long-term investment, just try to get the best deal you can, and use if you're handy, do some of it yourself. If you're not, stay away from it like the plague, because right, exactly, that was my next point, because there's nothing worse than a handyman that was terrible. What's easier, starting something from scratch or undoing something that somebody really screwed up?
Oh, we've seen some doozies.
Yeah,
remind me to tell you about the igloo cooler up in the attic that was used as a junction for air conditioning ductwork. And I love that. That's great.
Yeah, I've owned a lot of houses, and I've seen it all, and trust me, it is worse to have the handyman that tried to do it all himself.
I'm amazed at the thought process that goes into some of the stuff that they've done. I'm like, a lot of people would just laugh at that, and it is comical, don't get me wrong, but they actually took time to engineer that fix.
Right, like, there was a lot of thought went into that.
That's impressive. That's impressive.
Yes. So that's why with the renovation loan, you have to have a licensed contractor, and they have to be vetted by the lender, believe it or not. We just don't say, okay, you have a license, you can go. You actually have to.
So we do a lot of work for one of the local banks here. Lake Michigan Credit Union.
Very familiar.
They send us clients, and then clients of ours use them. I'm assuming they're good to do business with. I don't know. And we had to become qualified to work for them. Is that the same scenario?
Same scenario. Yeah, you just have to make sure that, because our liability is there as well. So we're saying it's okay for you to be the builder.
Right.
So there's some liability on the lender as well. So we want to make sure, and we want to make sure that there's longevity, because believe it or not, contractors do go out of business, and then how do you finish your house with, you know, when the contractor goes out of business? Because what happens in a renovation loan, like the purchase and renovation that we were talking about, if you buy it for $150 and your work to be done is $50, that money goes into an escrow account,
Right.
and the title company holds it, and you get paid in draws like a construction loan as you get work done. So you invoice for whatever you need,
Right.
and you can have up to 6 draws, which is a good amount of draws.
That should cover you.
Yeah, for most, you know, even new construction, you know, it's not a ton more draws. But, so that money is held there, and that's to protect the homeowner, because if the contractor did go out of business, then the money's still there. You don't, that's, I've done both, believe it or not, in Cleveland, like you were talking about, in Cleveland, when the mortgage meltdown, yeah, we were buying houses at, you know, $15,000, $25,000 a pop, rehabbing them, putting tenants in there, and getting, you know, $1,000 a month for rent, and you've got, you know, $25,000, $40,000 mortgage. So they cash flowed, and I did it 2 different ways. I did it all cash my own, and I did it with a renovation loan, investment property. I've done them both. You know which one I liked better? The renovation loan, God's honest truth. Because once that contractor, not you,
Not me.
but once that contractor knows that you're funding it all yourself, somehow the homeowner becomes an endless money pit. Oh,
Right.
this came up. Oh,
Yep.
that came up. Oh, this came up. When you have a renovation loan, you have to prove to the lender
Right.
that it's different from what's on your contract, that it's a legitimate change order, and you have to show them. And if you can't do that, you don't get the money.
So in my contracts, we give pretty comprehensive contract. My scopes of work are pretty detailed. And at the bottom of them, they all say the same thing. I don't include hidden or concealed conditions. So, you know, I always joke and say my X-ray vision's on the fritz, and I can't see behind these cabinets or what's inside that drywall. And so
Termites.
you run into, we just did a project not long ago. It was over in Lehigh, and we were renovating a bathroom, took the ceiling down, and it was ate up with termite damage. And
Welcome to Florida.
that has to be dealt with in a you know, she has a license, I have a license. Okay, so we have to deal with things in a very specific way. I can't just go and cut the termite damage out and throw it away. It just doesn't work that way. Now, you as a homeowner, you're allowed to do whatever you want to do. What I don't know, it's none of my business. But we went away on Friday, and the termite damage was there, and he called and said, okay, we're ready. Came back on Monday, and everything looked pretty and clean. I'm like, oh boy.
Oh, there's so much here. I mean, you know, we've got salt, sun, heat. You know, Florida is very, very hard, if you didn't know, on
Yes,
on everything, and you know, mold and just all these things. And there's, you know, it all goes on behind the walls, and you can't see it. So,
Right.
and you know.
A home inspector is a great investment.
But you know, HUD.gov, you know, HUD homes, you know, HUD always has homes for sale on their websites. Might not be in the perfect neighborhood, but they're always screaming good deals. You know, the VA has to buy homes back. Sometimes the VA has homes for sale. You know, different places where you can look that might not be on your traditional MLS for
Okay.
homes for sale. You know, for if you really want a good deal.
Let's talk about something that I just popped into my head. I think it's important to me. Pre-qualification. So if I feel like I'm about ready to put my foot in the water, do I go talk to my real estate agent first, which is actually what I did.
Most people do.
Actually,
Don't feel
I
bad.
talked to you. You referred me to my real estate
Yeah.
agent. In a perfect world, do I go and get pre-qualified with you first?
I mean, that would be perfect. You know, the realtor doesn't want to put you in your car or meet you out there or spend their time if you can't buy.
Right.
So it wastes their time, and nobody wants their time wasted.
Right.
You know, nobody wants to work for free. You want to get it for free, but you don't want to work for free.
Sure.
So it is good, and you know, for anybody buying, you know, using a mortgage, it's income, assets, and credit. Just 3 things. So. If you're a W-2 person, you know what your gross income is. If you're self-employed, you look at your adjusted gross income, not the income. It's the AGI on that first page.
Yep.
That's what you tell Uncle Sam that you make. And then credit. There's a lot of credit indicators out there. The only way you really get a bank or lender credit score is from a lender. Because everything else is more of a credit indicator. When you go to buy a car,
Right.
it's a credit indicator. Difference is, when you're buying a home, we've got to foreclose. It's a lot harder to get that money back. So we have to make sure that, there's another piece to that model, that credit scoring model, that adds a home into it to determine your risk. So, and I don't work for them. I have nothing to do with them, but I tell people to use Credit Karma for a credit indicator.
Right.
And you can. I like Credit Karma because you can watch if you have, let's say, you're overutilized on your credit cards and you pay them down. You can see from Credit Karma how much that changes your score. It's very reflective, more real time, on what you're doing with your credit. However, 9 times out of 10, that Credit Karma score is about 40 points higher than what a lender's going to pull.
Gotcha.
And I get yelled at from people that have I have an 800 credit score, and I say they have a 760, and they want to like throw me out the window. And I'm like, don't worry, it's a good score.
I didn't make the rules.
It's just, it's like you call it whatever you want, but we're going to use 760 over here. That's what we're going to use. So you need decent credit to buy a home. Unless you're doing a reverse mortgage, then you can have bad credit. That's a whole nother story.
So Laura, let me ask you a question. There's another one's coming into my mind here. I'm within, I think, 6 months of making a purchase. 6 months or less. Give me 3 don't do's. Definitely don't do these 2 or 3 or 5 things if you know you're within a...
Don't buy anything.
Don't buy any...
Don't buy a car. I get so many people that bought a car, because everything it hurts your debt ratio.
Okay.
Meaning your ability to purchase. So don't run up your credit cards. Don't open new accounts. Don't get a car. Don't do anything on credit. Go check where you are. If you're not where you need to be, you can always get your credit reports, all 3 for free, from annualcreditreport.com.
Okay.
They won't give you a score, but if you use Credit Karma, you kind of know what your score is. But annualcreditreport.com will give you your reports, so you'll know what's on there. If you have a collection or high credit utilization, you'll know the reason for your score.
Gotcha.
If you know the reason, you can go ahead and try to fix it.
Okay.
Because they don't want you. It's best to keep your credit utilization, I tell people, in like the 30% range. A lot of people, when they're first starting out, get those secured cards for $500, and then they put $500 on it. They go, it's like, then it's maxed out.
Right.
Because it's all about percentages. And what you want is that big Discover thing, that Discover credit card that has 15,000 credit limit, and you have $1,000 on it because your available credit is good. So they want to see that. They want to see that you could take loans like car loans and pay them off, or pay them down. So you don't want it to be new. You want to be a couple years into that car payment or what have you. So just see where you're at. Collections are the biggest problem, and misunderstood on how to fix it.
Okay.
I'm not a credit repair company, and I'm not associated with any credit repair company, but after 25 years, I've seen a lot of credit reports.
Okay.
And what people don't realize is that, the collection companies know how to hurt you. There's 3 credit bureaus: TransUnion, Experian, Equifax. It costs them money to report. That's how the credit bureaus make their money, is it costs money to report. So when lenders use the middle of the 3, not average, it's the middle. So all they have to do is hit 2 of them. So traditionally you will see 2 out of the 3 credit bureaus with bad scores, and then one's really high up here. So you'll know that they reported to these 2 with that collection.
Right.
Now an unpaid collection gets about as many negative points as a paid collection. So people go run and pay them off. Why didn't my score go up? Because it's still on there as an unpaid, as a paid collection.
Right.
What you need to try to do is negotiate and say, I'll pay you if you remove this from my credit report. Otherwise, why should I pay you?
Right.
And most people don't know to try to negotiate, because there's no reason, there's no law that says a collection company has to report this.
Right.
They just do because they want to get their money. They're in business to get money.
Yep.
So try to negotiate, try to see what's on there and get things removed. And if you can't do it on your own, if the score is bad, and let's say you had a very low score and you want to buy in 6 months because I'm getting married, we're having kids, we need a house. If you need to move fast, then there are good companies out there that do credit repair. There's also bad companies out there that just take your money every month and do nothing. So I know who the good are and I know who the bad are. Don't use a company, and sometimes it does take professionals because they can do it quicker than you can on your own. So definitely use something. I'm not saying you have to use Credit Karma, but use something to see where you are with your credit.
Is there a number? I monitor my number pretty closely once a month or so. I'm looking at it. Plus, I have a credit card that sends me my number every month.
Which will be a credit indicator card or a credit, indicator.
Yeah.
Yeah.
Is there a number, that if I came to you and I said, hey, I'm here roughly, that you're like, okay, we should have a decent chance of getting you financed?
And it depends on which. So like the government loans, like the FHA and the VA, the interest rates don't get better after 700. Lenders at 700. So you could have an 800 and it's like, thank you very much, doesn't matter.
Okay.
Conforming, it can go up to like 760, where, especially if you're doing the more risky, you're doing a condo, investment property, whatever, you're going to want to have that 760 score to get the best rates, because that's what it is. The rates change every 20 points. The rates change.
Okay.
And that's a small window. So 719 is not a 720. So there's no in between. It's a hard stop, every 20 points, 600, 620, 640. So, go from there. And, you can get a loan if you're in the 600s with the VA, but you're going to have a little bit higher rate.
Right.
But their rate bumps, as they're called, aren't as harsh as conforming is.
Okay.
They have a lot harsher bumps. So the government loans are always going to be more forgiving than the other ones. So, for first-time home buyer, FHA, VA, shoot for 700. If you're a seasoned buyer, investment property, all that, you're going to shoot for the highest score you can in the high sevens.
Okay.
So
good news.
So it depends on what kind of. Everything always depends. My answer is always, it depends. What is it you're looking for?
Everything is contingent upon something.
Correct. So hopefully we've helped find people some money so they can go hire you.
Yeah, well, that would be great, and hopefully we have educated some folks out there about financing their next renovation or new home build, and they will reach out to you. Is there anything else that you'd like to throw out there while you got the soapbox, so to speak? Have we covered it pretty well?
I think we did a good job.
We have dug deep.
So we pat ourselves on our back now, Reno? Okay. There you go.
Folks,
I appreciate you, Mark. Thank you for having me.
Tell people how to find you, if they want your services.
Best way to reach you is my cell, 216-272-1015.
Okay.
Laura Sanchez.
And you're happy to answer questions?
Yep.
Okay.
Education is the key.
Education is the key. You're making relationships,
and the call is free.
folks.
Don't forget, the call is free.
Call is free. And our office number here at Sunset Builders, if you want someone to build or to estimate these projects for you, 239-236-9646. Folks, my name is Mark Arnett. I own Sunset Builders, been in business for 16 plus years now, and would love to help you make your next dream a reality, all right? Give us a call. We'll see you on the next podcast.